Hi guys, this is Sebonga from Millionaire's Journey. We are continuing with our trading course. On the last lesson, we talked about short-term trading. We explained medium-term trading, long-term trading, and then we explained pullbacks, and then we explained again pullback trading strategies or how to trade pullbacks. This might have been a mistake because we talked about pullbacks, not breakouts. So let's continue. Today we are looking at market structure. Today we'll be talking about market structure. We'll be explaining the nature's theory. We'll be explaining the corrective phase, explaining the impulsive phase, and how to trade the structure. So let's get on with it. All right, family, let's get on with today's lesson. So today we are talking about structure. What is market structure? This is just a summary of what is market structure. I want everyone to have an idea. Market structure accommodates a series of highs and lows. Highs and lows are noticeable on all time frames and promotes the trend recognition. So market structure accommodates a series of highs and lows. We have higher highs, we have higher lows, we have lower low, and then we have lower highs. That's basically how the market moves, the structure. That's the structure of the market. So the market starts here on the low, and then it pushes up and create a high higher than this one. That's why we say higher high, because this high is higher than this one. And then it comes back and create a low, that which is a lower high, because this low is higher than this one. So it's a lower high because it's higher than the previous low, and then pushes up to create another high, another higher high. So we have a high, we have a higher high, and then we have a higher high. That means we have an uptrend because it consists of higher highs and higher lows, and then another higher low. We are going up, higher highs, higher lows, higher highs, higher lows. Then on a downtrend, we have a high, then the market creates a low, and then comes and create a high, but now this high is lower than this one. That's why we say it's a lower high. It's a higher low, lower highs. The high, this high is lower than this high, so it becomes a lower high. And then we have a lower low, a lower high, a lower low, and a lower high. So that's basically the market structure. That's how a trend is built, or that's how the trend is constructed. It's a series of lower highs and higher highs and lower. It's a higher high, higher low, lower low, lower high. I want you to go to the chart and see if you can spot any of this. Let's look at the nature's theory. What is the nature's theory? Nature's is the name given to a characteristic of price action. Price action can either have an impulsive characteristic or corrective characteristics. Forms a foundation of what the nature is. So what is nature theory? Nature theory is a name that was given to the theory of the nature of the market, which price behaves in impulsive or corrective characteristics. As a trader, you need to know whether the market is on an impulsive phase or a corrective phase. You need to know this. You need to know, okay, that Euro USD is on an impulsive or is on a corrective phase, because that's how we get trading decisions. This is the basis of how to trade, and most important aspect of technical analysis. Corrective and impulsive are very, very important on technical analysis. You need to know this if you're going to be a technical analysis. And as a trader, you need to know this anyway. All traders need to know impulsive and corrective phase. We believe that nature of the market is how we understand what is taking place on the chart. We look for trades and on the corrective phases. So the phase that pushes towards the trend is an impulsive, and the phase that goes against the trend is a corrective. Impulsive, corrective, impulsive, corrective. And I said we look for trades on the corrective phase. That's where we get our patterns, our rectangles, our triangles, our channels. That's where we get them. So when the market pushes down, and now you say, okay, now market just pushed down, you wait for a correction, and then this correction will present some sort of a pattern that you can recognize if you really know how to trade patterns. And you know that when that pattern breaks, another impulsive phase is coming, and then it will give you another channel, another corrective phase. We will have examples of this. We will look at the examples of this, and you will understand exactly what I'm talking about. It gives you another pattern, and you know that when that pattern breaks, you are pushing down. That's how you can trade impulsive and corrective. And you know that, okay, if the price gives the impulsive and then starts correcting, but the correction actually comes to break the previous high, now the trend is likely that the trend has changed. If the correction comes and break the previous correction, that means the trend has changed. Or it can be just a bigger correction to push, and then we'll turn this whole move into one impulsive structure, and this will be the corrective structure. Once you develop an eye to see this, it will be easier for you to trade, because now you see that, okay, the market is on the impulsive phase. Let me wait until it gives me correction, and then after correction, that's where I can join the trend. So basically, you are trading with the direction. Same apply with an uptrend. If the price pushes up, you wait for a correction, and then on that correction, you look for a pattern that you know. You don't just jump into correction. Correction should give you a channel, a rectangle, or a triangle, or another patterns that we've talked about. And then when that pattern breaks, you are looking for a trade, and then another correction should give you a channel. And then when the pattern, and when that pattern breaks, you are going up. And then when it gives a correction that comes to break this previous low, you are either looking for a correction of this move, or this move itself is a correction to another side. So it's a bit tricky, but you will understand. Let me show you here. You see here we have a correction. When it breaks, we catch a trade, and then we had a descending channel, and when it broke, we had a trade, and then we have something like an inverse head and shoulder, and then when it broke, we pushed up. So the market moves in the patterns that we talked about. That's why I said it is important not to miss these patterns. And then again, we have a correction impulse, we get some sort of a channel, we have a breakout and a pullback, then we push down, and then we get another correction here, something like an ascending triangle, and then when it broke, we've pushed down. So the market moves in this pattern. The market shows you these patterns each and every day. You're just not looking for them. You are just not looking for these patterns. So let me explain deeper into detail what is impulsive move and what is corrective move. So an impulsive move is a technical trading term that describes a strong move in a currency pair price continuing with the main trend of an underlying trend, in the main direction of an underlying trend. It is a method for analyzing, predicting financial market moves. Impulsive waves can refer to upward movement in an uptrend or downward movement in a downtrend. So if we have an uptrend, we are looking for impulsive to the upside. These are the impulsive. The bigger moves are the impulsive. Understanding impulsive moves. Regardless of the time frame used, impulsive moves always run in the same direction as the trend at the large degree. So even if you're on a 5 minute, an impulsive move will be the same in the 1 hour. It follows the trend. It follows the direction of the trend. An impulsive move is whereby the market moves quite strongly or heavily in one direction, covering a distance in a short period of time. So it just pushes up and gives a lot of pips in a short period of time. These moves tell you when the imbalance between the buyers and sellers is really strong and there is a heavy participation from the instrument. So if the market push up like this and then it pushes slow like this and then pushes up like this, now we see that okay, the sellers are weak and the buyers are strong. They push faster and then it comes and then pushes slow and then again it pushes up faster. Now we know that the buyers control this market. Whenever sellers come in, it becomes a bit slow, and then when buyers kick in, it pushes up. That's how we know that okay, the impulsive move is to the upside. Buyers are controlling this market. Buyers are ruling in this market. You see, impulsive, corrective, impulsive. So now that you understand what is correct, what is impulsive move, let's look at corrective move. A corrective move during an uptrend is characterized by a move lower or even sideways, unlike impulsive move. Corrections are formed in a mixture of bullish and bearish candlesticks whereby the bold is relatively small. Correction, or in other words pullback or retracement, is a relative short-term movement of the market in the direction opposite to the main trend. A correction will be bearish in a bullish trend, while the bearish trend, a correction will be bullish. So if we have an uptrend, the correction will be to the downside, and if we have a downtrend, and the correction will be to the upside. That's how it is. So you see here on this picture we have an uptrend. You see the impulse is to the upside, the correction is to the downside, and then we have another impulse to the upside. You remember I said we're looking for these patterns on the corrective phase. The corrective phase is where we get our trading patterns. You see, we have a corrective move and then it comes and gives us a channel, and then after the break of the channel we are continuing. Same here, we have an impulsive move and then we have a descending channel, and then we have another impulsive move after the break of the channel, and then here we have another impulsive move, and then we have a rectangle or a channel, and then at the break of the channel we are pushing up, and then here we have another impulsive move and a correct impulsive, and then we see here is a correction. After the break we are pushing. These are continuation patterns. Same, we have a symmetrical triangle and we have a descending triangle. They all break, and all these things are opposite for a downtrend. These things are opposite for a downtrend. So that's how you can combine the impulsive move with the corrective move to your advantage. So How to trade corrective structure to catch impulsive structure. You can enter before the pattern breaks. You can enter after the pattern breaks. A stop loss will be under the pattern or above the pattern. Take profit depends on your strategy. So let's say you just saw that the market recently impulsed or had an impulsive move to the downside. What do? You are waiting for market to present some sort of a corrective move. This can be seen as a channel, ascending channel. And then when that channel break, let me show you. When let's say this is your channel, when that channel break, you are looking for selling opportunities. You see, it impulsed a bit and then it gave another flag, and then after the break of that flag, you would have entered a sell here and then pushing to the downside with it. So you can use, you need to know a price channel because of this. You see here, again here, this is a pattern, and this is a pattern, and this is a pattern. So when you know the patterns, you know that if they break, you are looking for trading opportunities. That's the idea on how to trade corrective structure to catch impulsive moves, because you won't know how to catch the impulsive moves if you do not know how to trade the corrective structure. So that's about it on today's lesson. I hope now you understand what is impulsive move and what is corrective move. That was the main purpose of today's lesson. Thank you very much and enjoy the rest of the day.